So thank you for joining us today as we kick off our first webinar Wednesday. The CoLab LOs, loan officers, are going to be hosting these each Wednesday at 12:30. I apologize for my voice here today. They're going to be 20 minutes, and then we are going to have a Q&A at the end. I want to keep to that for all of you and respect your time. So in case there are some of you who I don't know, I'm Megan Marsh. I'm one of the co-owners of CoLab Lending. And so what we're going to cover today is we are going to be covering a strategy that will help you in today's market where homes are selling for over asking price and appraisals are coming in low. I feel like that's one of the biggest problems that I hear about. So to help you with your buyers and help win in bidding war situations, your buyers need to be willing to go higher and understand how they can make up that difference. And if they're not comfortable doing that, which a lot of people aren't comfortable when it comes to one of the biggest investments that they're making, we need to find ways to do that. And we need to find ways for your buyers to say, okay, can I make up a $10,000, $20,000, $30,000 over asking price difference if it doesn't appraise, or can I make that offer? And this strategy that we're going over today is going to show you ways that we can help buyers become more confident and how we can work together as professionals in the real estate industry. So what we started noticing that over this past year was we saw a market where listing agents are asking for addendums, where they're asking a buyer to bridge an appraisal shortage, which we've never seen before. I don't think I've ever seen it in 18 years. As an agent, it's stressful. Like, you're showing people homes, home after home after home. And if you have a buyer who isn't getting an offer accepted, it's exhausting. The sellers are nervous. They're excited that their house is worth more, but they're nervous. What if it doesn't appraise? Which deal should I take? And then once the loan goes into processing in the mortgage process, if the person doesn't have that amount, the difference, we're seeing deals fall apart more than ever. And so, as real estate agents, you need to be armed with things that help you on the front lines. Like when a home pops up on the market on the MLS, you need to be able to, I call it, go into battle and have the best shot of getting your offer accepted. And so this strategy is going to serve two purposes that we're showing you. It's going to show you how your buyers can become more confident in making those offers over asking price, and then how we can also bridge that gap if the home doesn't appraise. And just to kind of summarize that, I always say, like, the key to winning is doing it together and forming, I like to call them power partnerships, where we put our heads together, we teach each other things, and we use these strategies to win in the marketplace. So winning in the marketplace is going to come down to some of these solutions that we're going to really arm you and be able, so you can go to the front lines with it. So let's just dig right into strategy number one. And I put this together with a conventional offer, since that seems to be the type of offer that most listing agents and sellers feel comfortable with. We're going to look at a scenario. We're going to look at what typically happens when a buyer puts an offer in, and we're going to look at what happens if the appraisal comes in short and the way to bridge that gap. Now I'm going to pull this up on my screen so you can see the numbers. So I'm going to go away for a second here. All right. So in this scenario, we have a home that goes under contract. I use $275,000. So in the first row, it says original sales contract. So you've got a purchase price of $275,000. I used our best case scenario. It doesn't come in short. If the house appraises for $275,000, then we have a loan amount. If someone's putting 20% down just to start this off, somebody would be putting down and having a loan of $220,000. I used an interest rate of 4%. Their housing payment would be $1,768. They have a down payment of $55,000, closing costs of $11,821, with a total amount they would need to bring to closing of about $66,821. So that's our normal scenario, best case scenario. So then what happens when in the second column, the appraisal comes back at 260? So what I did was I broke this down for you at what it usually looks like. So it usually looks like in this market where it's a seller's market, the seller's like, well, I'm selling it at 275 because I had multiple offers. It appraised for 260. And so if your buyer wants to keep their 20% down, their same rate, if you keep going down, their down payment changes now. It lowers a little bit, but they have to bring those extra funds to closing, typically another $15,000. Same closing costs mean that now your buyer is bringing $78,800. So they're having to bring an extra $12,000 to the table. So this is where this strategy starts coming in, is if you keep going down, there is a way to have your buyer not bring that difference and still have the same loan amount in the column, the same interest rate, the same housing payment. So if we keep going down here with that appraisal, you keep your loan amount the same. And all that we're doing, if you keep going down, there's zero funds to cover the appraisal. Let's look, the closing costs are now going up from 11,800 to 13,471. So this is one of the strategies. And what we're doing here is we're playing with equity positions and mortgage insurance options to help your borrower be in the exact same place and not have to make up that $15,000 gap. And so if you look all the way to the bottom, compared to needing $66,821, your buyer now, even if it appraises at 260, would only need $68,471. They'd still have the same rate. They'd still have the same housing payment. They'd still have the same loan amount. And now they're only bringing, it's like $1,600, $1,700 more to the table instead of that $12,000 higher. And I even took it a step further. What if that appraisal comes back at 248? So now if we're looking here, typically it looks like once again, if your home buyer is going to be doing this, they're going to need to bring that difference. So that 27,000, if you go all the way down about 2 lines above the green, they're going to need to bring $27,000 to the table. And they're going to need 88,000 instead of 66. So now they're bringing $22,000 more to the table, which there's definitely buyers who don't have that. So if we keep going down here, we can keep our down payment the same as what they originally planned on doing. We can keep our loan amount the same at the top. And once again, if you look here, we are playing with loan programs as a broker with how many we have. And we're finding ways to use our mortgage insurance options and ways to use the closing cost to pretty much keep everything the same, not have mortgage insurance like they originally planned. And now they're only bringing an extra $3,800, $4,000 to the table. And this is important, not just after the appraisal comes in low. It's important for us also to show our home buyers these things, because now you can go into an offer with a house, let's say it's listed at 260 even, and you can offer 275 on that. If your buyer knows, look, okay, I've got 66,000. I was planning on putting this down, but I don't have 80,000. I don't even have 78,000. But if I can use one of these strategies, I can go in and make an offer higher than what they're asking. And it gives you a buyer who is going to be a lot more confident when you call them and say, hey, there's a new house on the market. Let's go look at it. And you find out there's going to be 5 offers being presented. Now you can confidently have your home buyer sign an addendum saying, hey, I'll bridge up to 25,000 in a gap. And so that is where this really comes in. Now, I did not dig into all the details of it because it is confusing, but usually what people care about, especially our buyers, is they want to know, what's my payment, what's my rate, what's my cash to close. And that's what we're doing here. And we have a system that actually breaks this down for them and can show them that. So when they go to look at a house, we can quickly plug these in and show them where we can work with that gap so they can make that stronger offer. Now, strategy number 2, I wanted to do an FHA because we can do this. We can do the situation I just showed you with conventional loans. With as long as somebody's doing a conventional loan, 5% down, it gives us the flexibility to work with that equity. Once you start getting into your loans, like your government loans that have lower down payments, it is more difficult, but there still are some tools we can use. So I wanted to at least show you what tools you can use with a broker. So this is where what's called lender credits comes in. And you can use them to your buyer's advantage and ultimately your advantage if you can sell a home sooner to a buyer and not have to keep showing them homes. So if you look in the first column, once again, we've got our original sales contract for $275 with an interest rate of 3.6, our housing payment, our down payment. And let's say that your home buyer needs seller's assistance for $10,000 so that they only, need $11,500. So let's go to the second column. In this case, if the house appraises at $260, well, now you've got a home buyer who now needs $25,900 if they're still getting the seller's assistance of $10,000 in there. And so some of the ways that how you can use lender credits at a brokerage, and you can find out roughly what they are. They're kind of like rates. They can change every day, but for the most part, the market, when it moves, the credits are still there. And so if you look at the 260 appraisal, I'm increasing the interest rate here to 4.25. We're lowering the purchase price to $265. And we're allowing the seller to drop off that $10,000. And what it's doing, if you go down to the bottom, is it's starting to save your buyers so they don't need $26,000 like in column 2. Now they're needing closer to $21,500. So it's saving them $4,500. I mean, that's not pennies. It's starting to make up that difference. And if you look in the far right column, we're increasing the interest rate a little bit further to 4.75, to where now the total amount that they need to bring to closing if they lower that purchase price to $265 is they need about $18,300. We're getting a lot closer to our original $11,500. And the 4.75 was not even the highest rate. We could have gone even a little bit higher and we could have gotten even more credits. So we can use these lender credits if you have a house where a seller is willing to look at an FHA or a government offer. Keep that in mind. Now, I don't want to be naive in that you guys are probably, you might be thinking like, okay, Megan, well, that's great, but they don't have to bring as much money, but some of my clients are worried about buying something that is way overpriced. So what I wanted to do was just look really quickly at this bid over asking price calculator that we have. And what this is doing is it's showing us what the 5-year forecast is with an appreciation rate. It's all based on data. It's taking the 5-year appreciation at 4.5%, and it's showing the home buyer, look, if you offer over asking price here, here's what it's worth. We've had this really big jump in equity this year. And by 2023, next year, this home, because I put it together where the asking price was $260, you're suggesting they make an offer $15,000 higher for a total of $275. So they're estimated, in the estimated current value right now is $264. So if you keep looking here, what it's doing is it's showing them, look, like you're not going to get yourself upside down if the market does what it's been doing. here's what it's been doing. Here's historical. Here's where we're projecting it to go. So by next year, the house is going to be worth, where was it? The house is going to be worth it breaks you even, that dark purple right there. And then by 2027, they're saying the house will be worth 325. Now, this data that's pulled, they tell us right in there, and you can see it here where it says AVM accuracy is about 90%. So this is about 90% accurate. So this should give your buyers some of that confidence to make those quick decisions and make better offers. And I put one more for you in here, which is this report shows your buyer the cost of not buying. I know this is small, so anyone attending, I will make sure as a follow-up that you can get a copy of this or connect with the loan officer that you work with at Collab Lending, and they can get you a copy of this. So what this is showing is if somebody wants to give up, they're like, I didn't get my offer accepted. There's no point. I'm going to wait a year or two. And what it's doing is it's calculating the difference that they will have to pay if they wait. So it's doing it 3 different ways. It's showing your home buyer, hey, if you wait 6 months in this type of market, if you wait just 6 months, your payment is going to go up by this much. So you're going to lose cash flow in 6 months when you go to buy it and you're paying more per month because the house is worth more. They're calculating it as loss in appreciation and loss in amortization because the house is going up in value, but they don't own it. And so this is an actual property that I pulled, an actual address right here near my office. And it said, okay, and if you wait 6 months between those 3 things, you're going to lose about $16,000. If you wait 2 years, you're going to lose $39,400 if you wait. Do you really want to wait, or do we want to figure out how to make stronger offers? And then the last one here, strategy number 3, which I just used a week or 2 ago with a home that went under contract for $620 here in Erie County, is the appraisal waiver. It's a pretty simple strategy. In order for us to work with you on this, we need your help. So we can run, if the buyer's been pre-approved with us and you have a property address that you are putting an offer on, we can run it through our automated system. But the one thing I want to explain here before I show you the next screen is that there's Fannie and there's Freddie. And this is really important because as a broker, we work with all these banks, and bank A will use Fannie, bank B will use Freddie. If your buyer is going and working at their local bank and they use Fannie or not Freddie, because that's usually how it works. Even at the brokerages I've worked at in the past, the system only runs it one way. Now, here at Collab, Andre and I, the owners, have made sure we've stayed on top of technology. We're in the groups, we are in front, and we are beta testing some of the best technology. And what it does here on this next screen is it allows us to run systems side by side and compare where our best option is. So not only are we looking at what bank has the best rate or where we can do this, we're running a scenario, and it's telling us what this says is, if you look on the left, AUS results, second one down says appraisal waiver eligibility. It's saying, hey, Fannie Mae will give you an appraisal waiver, but Freddie Mac won't. That means to me, if I ran this and was like, oh, I'm just going to put this at Northwest Savings Bank as an example, a bank that we use, they only use Freddie Mac. I'm not going to get a waiver. So I know now, okay, I need to pick a bank that uses Fannie Mae. And guess what? You can submit an offer knowing we can waive the appraisal, not just have an addendum for the difference. We can actually waive the appraisal. I don't think there's anything much stronger than that. Now, not every property will get one. That's one of my warnings, but you can use these. And this is where, when you get in a groove with a loan officer, they can do this very quickly. So kind of in summary, I would highly recommend, if you don't work with someone on our team at Collab Lending, I would just suggest that you align yourself with someone who uses these strategies. And the last thing I just wanted to point out was that, not sure if anyone understands or knows why mortgage brokers can use some of these tactics, and you can't use them always at other places. And that's because there's three types of lenders out there. There are brokers, there are what are called correspondents, and there are retail lenders. And of those three groupings, brokers are the only ones that are capped at what they can charge or make on a loan. They did this to make sure consumers were being protected. So for us, it doesn't matter what rate someone picks, it's more strategy based, and we always get paid the same amount. The thing is, for the most part, the market has more money than what we can make. So what we get to do as a broker then is that we get to use this extra money to find ways to make things happen and to help you and your buyers have these advantages that can make up for appraisal gaps, that can use as lender credits when you're making offers. And so that is why I think this is one of the most powerful things that you can do in this market, because we don't know how long it's going to last, because it's going to result in confident buyers who are willing to make aggressive offers. You're going to have solutions if the appraisal comes in low, and you guys are going to be successful as realtors, and you're going to sell more homes and be less stressed if you have these solutions to solve problems when you're making the offers and when the appraisal comes in low. So my suggestion is to connect with a member of our collab lending team. I have the website and our phone number here. Bring this back over. There we go. So just to summarize the three, you've got three strategies in our appraisal gap strategy. The first one is where we're using equity and mortgage insurance to make up these $15,000 to $28,000, $30,000 gap. Higher the price goes, the more we can bridge that gap. Second strategy is we're using lender credits to replace and help pay closing costs, cover for seller's assistance. Third strategy is the appraisal waivers. So those were the three strategies today. And then next week, we are going to be going through helping your self-employed borrowers, 1099 business owners, with some strategies that we really specialize in here at Collab Lending. And with everyone leaving their jobs, these are going to be really important. So that is it for today for this strategy. If anyone has any questions about the appraisal gap strategy, if you want to put that question in the chat, and I will take a moment, look over there and answer them. And then we will make sure that we can replay this. And that it's at a spot, we will send out the link so that you can re-watch the webinar. But we'd love to connect with you and explain any more questions about this to you. All right, so I do see one question. It says, does that mean that the bank won't require an appraisal? That is correct. So when we run that the appraisal waiver, it tells us, right, eligible, not eligible. If it says eligible, we get to go to the home buyer. So the contract I received last week or the week before, we went to them and there's a form and they have to agree, which usually then the agent and ourselves are like, yes, agree, you want to agree. And they have to sign it saying, yes, they understand they're not going to get an appraisal. And there is no appraisal. So there is no chance of it coming in short. One thing with that, I don't think I mentioned is the appraisal waivers are we're really only seeing them when there's 20% down. So those are for your conventional buyers with 20% down, but gosh, all the closings we have every month, I'm telling you, we probably have half a dozen a month. 10% of our pipeline, I would say, are getting appraisal waivers. So if you are selling homes and you have never had an appraisal waiver, that's where I would say to really think about the lender that you're using and to get a second opinion, mix it up, because those of you who are working with Collab Lending, you should, if you've had conventional buyers, you should have some appraisal waivers in there. So if there's any other questions, otherwise I'll stick on here for a few minutes, but otherwise I will send this out to everyone. And I hope that this gives you some great tools to head into the market with. Connect with your loan officer you can get those customized reports for houses and these breakdowns, and go get them.